Hello and welcome to this latest Wealth of Advice market update recorded on the 9th of May 2024. Thankfully, the sun has appeared in the United Kingdom, it seems, for the first time since the beginning of the year, and people, I think, are genuinely feeling better. Good weather's here, but also market returns have been good so far this year, so certainly when we're sitting down with clients having reviews, all our clients seem to be feeling a lot better than what they were, certainly at the back end of 2023 when we were still worried as to what was going to happen next with markets. Markets obviously shot up over the next 6 months on the back of the expectation that in America their interest rates would come down. The Bank of England held an interest rate committee meeting just this afternoon at lunchtime. They've decided to keep our interest rates on hold at 5.25%. However, there is still the anticipation that rates will come down in the coming months. But April saw negative returns for global equity markets. And I think this was to be expected. And when we were speaking with different fund managers, they were all saying was if you look at any bounce back, any bull market that's happened in history, you will get a good surge at the beginning of it and then a little bit of a pullback as markets sort of sit down, take stock and realise maybe they've moved ahead too quickly over that first 3 month period. That's certainly what April felt like. There was a decline in all global equity markets after a very, very strong rally. Believe it or not, UK stocks and shares have bucked that trend. The FTSE 100 has hit another all-time high recently. I will say that with a little caveat. If you'd have invested in the FTSE 100 over the last 5 years, the returns are nowhere near as good as if you'd invested in other global markets around the world. But that said, it is positive the fact that markets in the UK have gone up. It does show you that the UK economy has held up better than what was expected previously, when most big experts around the world were saying that the UK economy would be one of the worst of the developed nations, which didn't happen. There's been strong US employment data in America, and retail sales over there suggest that people are still out there spending money. So again, this global recession that was feared in 2023 didn't happen. But the flip of that now, and this is why interest rates aren't going to come down as quickly, is the fact that people are still out there spending money. So although companies put their prices up, we by and large continue to go out and spend. So these companies are now announcing record profits. Tesco in the UK a few weeks ago announced record profits of £2.5 billion, which is absolutely fantastic for Tesco's shareholders. Not so fantastic for those people who were paying those extra price increases, which we were told was as a result of the war in Ukraine, as a result of supply chain issues, as a result of everything. But ultimately, a lot of big companies profited through that. And from your point of view, if you're invested in these markets, that's going to be good because these companies will declare good profits and the share price will go up. Interest rate expectations has been the main cause of market volatility. The fear that interest rates won't come down in the coming period as quickly as what was previously anticipated is what caused the markets to dip in April, and that's why markets are bouncing up and down. At the beginning of the year, it was expected that the US market, for instance, might see their rates cut by 6 or 7 times in 2024. That expectation is now to be more likely 1 or 2 cuts only towards the end of 2024. I think obviously the crunch point will come if the US inflation data does come down to a level where the Fed's happy with, but also if they were worried that as a result of having high interest rates it could cause a kind of a recession or something, then we might see some action. But right now, economy seems to be holding up. We're not seeing businesses go bust as a result of high interest rates. We're not seeing massive house repossessions as a result of high interest rates. We kept hearing as more people come off fixed rate mortgages, you might say more repossessions. Housing sector might drop massively. Well, it has dropped a little bit, and demand for new properties has certainly come down, but we haven't seen an absolute collapse. And I think part of why you've seen a slowdown in the housing market may be because if you were a first-time buyer or somebody thinking about moving house maybe, and you were being told in the newspapers and on the press, on the news channels and everything online was saying we're going to see interest rates come down in the summer, you might think, oh, well, I'll hold off buying a house until the summer because interest rates will be cheaper. Maybe now, as a result of the Bank of England putting rates on hold, that'll move things along because people will only wait so long. But overall, as we approach the halfway point of 2024, I'm very happy with how we've seen this year perform so far. Yes, April was a disappointment, but we've bounced back, and May so far, we're only sort of 9 days into the month, has been a positive sort of pullback so far, and we expect this to continue as the year continues. the threat of geopolitical risk, i.e. what's happening in Russia, Ukraine, what's happening with China, what's happening in America with Trump and Biden, that seems to have taken a bit of a backseat as far as markets are concerned and what's causing the volatility. And if we look now at the VIX index, an index which shows like level of risk in stock markets, you can see how it did go up in the month of April, but it's come down again recently. So markets seem to be a little bit calmer than what they were, but they would love to see an interest rate cut. So we now come to that part of the update where we show you how markets have performed so far. Mentioned a few minutes ago there that the FTSE 100 has reached an all-time high just in the last few days. But as you can see, FTSE 100 is up 9.12% so far this year. After being in the doldrums sort of January into February with negative returns, it's come along quite nicely since March, as you can see there. S&P 500 up 10.81. S&P got to all-time highs at the end of April. And again, when it's talking about risk in the world, the VIX index going up during the month of April, most of the sell-off that we saw in world markets was from the American stock market during the month of April, mainly borne out because of the fact of all the big seven, the huge colossal stocks, the Amazons, Apple, Netflix, Tesla, all these stocks, the big ones, their share price had risen so much. And I think a lot of big investors wanted to take some profit off the table with everything that's going on, and the concern about interest rates not coming down certainly magnified that, and you saw a big sell-off. But thankfully, as you can see from the start of May, as I've said there, things have picked back up again nicely. So if you had been invested in the S&P since January, you're up 10.81%. And the global world index 9.61. So the FTSE 100 definitely holding its own in amongst those three indexes there. When we compare that over 1 year, FTSE 100 lags right the way behind, 11.14% over 12 months compared to the S&P 500 being up 27.5%. And interestingly, we were saying this to a potential new client who came in the office just a few days ago. Why didn't you come to the office a year ago when all these stock markets were so much lower? And the answer to that simple question is there was still a lot of fear in the world at that point. People will want to invest money when things have gone up, which is obviously the wrong time. You should be investing when markets are absolutely on the bottom, but you won't because, as I say, there's a lot more fear at play there. But thankfully, clients seem happier. Everyone seems more confident. Markets have picked back up, and let's hope it continues. The 5-year performance graphs, it'll be good this time next year when we can have this sort of update, and that COVID fall off a cliff will definitely not be on the screen because it'll be more than 5 years old. We've gone past the 4th anniversary recently, and if you had been invested all the way through from June 2019 till now, you would have made some good returns, and you would look at that graph and say, COVID, what COVID? Yes, it was a massive drop off, but it recovered quite quickly. We then got to the end of 2021 and we saw another massive sell-off of global stocks and bonds. Everything fell during 2022. It was one of the worst years that I've worked through from the point of view of everything that could go down in value did. It was very similar to the financial crisis of 2008. And I think personally, from my experience, it seemed to last longer and go on a lot longer than the financial crisis of 2008. But then, as I say, look at those returns since October 2023 till now. So the last 6-7 months have been fantastic. And if you had been invested over that long term, you would have made some good returns. So those clients who haven't been invested quite as long, look at the big picture, look at the longer term returns, and hopefully, as I say, you will get these good returns over the long term as well. So thanks for listening to the Wealth of Advice Market Update. If you have any questions or queries as a result of anything we've said today, please don't hesitate to get in touch. We obviously record these updates on a monthly basis now, trying to give you the best insights we can as to what's going on in world markets and how it may affect your investments or pensions. But if there is, as I say, anything that worries you, don't hesitate to get in touch anytime.